Yesterday's Fed meeting wasn't just another update. July 30th might go down as the day the crypto market entered a new phase, because what Jerome Powell revealed between the lines could mean trouble ahead. Here's what you need to know. They didn't raise rates. But the markets reacted like they did. The Federal Reserve decided to hold interest rates steady at 4.25% to 4.50% for the fifth meeting in a row. Powell acknowledged that inflation is cooling, but made it clear that it's still not under control. He said, "We're not yet confident that inflation is sustainably returning to 2%. Translation? Rate cuts are off the table. For now. But here's what really matters. Two Fed officials, Waller and Bowman, dissented. That's the most internal disagreement since 1993. And when the Fed is split, markets get nervous. But here's the signal nearly everyone missed. And the charts are already reacting. The crypto market didn't crash, but it blinked. Bitcoin slipped about 0.9%, landing around $117,100. Ethereum and XRP dropped between 2% and 2.5%, and Solana sank over 3%. Ethereum held up a little better thanks to continued ETF inflows and institutional demand. Meanwhile, in traditional markets, things turned defensive. Bond yields climbed. The dollar hit a one-month high. Investors started moving into safe havens. And when that happens, crypto cools off fast. Think crypto shrugged it off? Not quite. The last time we saw this kind of Fed dissent, Bitcoin dropped double digits, quickly. History doesn't repeat. But it definitely rhymes. Jerome Powell's tone was sharply cautious. He said the Fed will remain data dependent, meaning every inflation report could move the markets, dramatically. What's worse? Traders are no longer expecting rate cuts anytime soon. CME Fed Watch shows only a 2% chance of cuts in July, and projections for September or December are fading fast. That means we're likely stuck in a high-rate environment for longer than expected, and that's not good for risk assets. Because crypto needs liquidity to thrive. And liquidity? That's exactly what the Fed is squeezing. So where does that leave you as a crypto investor? Do you ride this out, rotate into strength, or exit before it's too late? Here's what smart money is doing. First, cutting risk. Avoid meme coins or low-cap speculation, they drop fastest in uncertain markets. Second, leaning into resilience, Bitcoin, Ethereum, or yield-bearing assets like staking or tokenized real-world assets. Third, holding cash on the side. Because if the Fed does pivot, that dip could be the biggest opportunity of the year. You can't control what Powell says. But you can control how you position yourself. Now I want to hear from you. If rates stay high through the end of the year, what's your next move? Are you holding? Hedging? Or exiting? Drop a comment below, I read every single one. And if this update gave you clarity, smash that like button, subscribe, and turn on notifications. This is your daily edge in crypto. Stay sharp.